For many e-commerce entrepreneurs, accessing capital can be a significant hurdle to growth. Traditional bank loans often come with stringent requirements, lengthy application processes, and personal credit checks. This is where options like Shopify Capital step in, offering a potentially faster and more accessible route to funding for businesses already operating on the Shopify platform. But is it truly a beneficial solution for your business needs? Let's break it down. Understanding the process for beginners. Shopify Capital isn't a traditional loan in the sense you might be familiar with. Instead, it offers two primary funding options. Merchant Cash Advance. MCA, this is essentially an advance on your future sales. Shopify gives you a lump sum up front, and in return, they take a fixed percentage of your daily sales until the advance amount plus a fixed fee is repaid. There's no set repayment deadline, meaning if your sales are slow, you pay back less on that day, and if they're booming, you pay back more. Term loan. Available in some regions with term loan. You receive a lump sum and repaid in fixed, scheduled payments, usually on a daily or weekly basis, regardless of your sales volume. This comes with fixed borrowing cost, similar to an interest rate, but often referred to as a factor rate. How it works, step by step. Eligibility is automatic. Unlike applying for a traditional loan, you don't typically apply for Shopify Capital. Shopify continuously assesses your store's performance, sales history, consistency, customer engagement, and adherence to their terms of service. If your store meets their internal criteria, you'll receive an offer directly in your Shopify admin dashboard. Offer presentation. The offer will outline the funding amount available, the fixed fee for MCAs or borrowing costs for term loans, and repayment percentage for MCAs or fixed payment amount for term loans. You'll usually have a few different options to choose from based on varying amounts and repayment terms. Acceptance and funding. If you decide to accept an offer, the process is usually very quick. Once accepted, the funds can often be deposited into your bank account within a few business days. Automatic repayment. This is a key feature. Repayments are automatically deducted from your daily sales for MCAs or at regular intervals for term loans. This means you don't have to manually make payments or worry about missing deadlines. Is it worth it? The worth of Shopify Capital largely depends on your specific business situation and needs. Potential advantages. Speed and convenience. The biggest draw is a rapid access to funds with minimal paperwork. If you need cash quickly for inventory, marketing, or unexpected expenses, it can be a lifesaver. No personal credit check. Eligibility is based on your store performance, not your personal credit score. This can be beneficial for entrepreneurs with limited credit history or past financial challenges. Flexible repayment. MCA for businesses with fluctuating sales. The MCA model's percentage-based repayment can be advantageous. You pay more when you're making more and less during slower periods, which can help manage cash flow. Seamless integration. Since it's built into the Shopify platform, managing the funding and repayments is integrated into your existing workflow. Potential drawbacks. Cost. While there's no traditional interest rate, the fixed fee or factor rate can translate to a higher effective APR, annual percentage rate, compared to some traditional loans, especially if you repay quickly. The convenience comes at a price. Lack of transparency. Eligibility. Shopify doesn't publicly disclose its exact eligibility criteria, which can be frustrating if you're trying to qualify or understand why you haven't received an offer. Non-negotiable terms. The offers are typically take it or leave it, with little room for negotiation on the fee or repayment terms. Automatic deductions. While convenient, the automatic deductions can be a downside if your margins are tight or if you prefer more control over your cash flow. Limited control. If you get a merchant cash advance, you're essentially selling a portion of your future revenue, which can feel like giving up some control over your incoming funds. Before accepting any Shopify capital offer, calculate the total repayment amount and compare it to the initial amount you receive. Then, consider how quickly you realistically expect to repay it based on your sales projections. Divide the total cost of the funding by the repayment period, even if estimated for an MCA, to get a clearer picture of the effective cost relative to other funding options. Don't just look at the initial amount. Understand the true cost over time. Always weigh the convenience and speed against the overall expense to determine if it aligns with your business's financial health and growth strategy.